If you're freelancing in 2026 and you haven't sent the IRS a dime since April, your September 15 estimated tax payment is about to get expensive if you guess wrong. The IRS underpayment penalty rate sits at 8% annualized as of the Q3 2026 rate announcement. That's the same elevated rate the agency has held since the Federal Reserve's higher for longer stance pushed short-term rates up. And here's the kicker. Most freelancers I see overpay Q3 because they panic, or underpay because they used last year's number without adjusting. Both are wrong. By the end of this video, you'll know exactly how to calculate your Q3 2026 estimated tax payment using the safe harbor method, the same method that legally protects you from penalties even if you owe a fortune in April. Let's get into it. First, let's talk about what the safe harbor actually is, because this is where most freelancers leave money and protection on the table. The IRS doesn't actually require you to predict your 2026 tax bill perfectly. Under the safe harbor rule in Section 6654 of the tax code, you avoid the underpayment penalty if you pay in, through withholding and estimated payments combined, either 90% of your current year tax liability or 100% of last year's total tax. That second number jumps to 110% if your prior year adjusted gross income was over $150,000 or $75,000 if you're married filing separately. According to IRS Publication 505, this is the cleanest legal shield a self-employed person has. My take is simple. If your income is volatile, and most freelance income is, use the prior year safe harbor. It's a known number. It's on line 24 of your 2025 Form 1040. You don't have to guess what December will bring. You just have to divide and pay. Now let's actually run the math, because abstract rules don't pay quarterly taxes. Let's say you're a single freelancer, and your 2025 Form 1040 line 24, your total tax, came in at $18,000. Your 2025 AGI was $120,000, so you're under the $150,000 threshold, which means your safe harbor target is 100% of that $18,000, not 110%. Divide $18,000 by 4. Each quarterly payment should be $4,500. That's it. If you've already paid $4,500 in April and $4,500 in June, your Q3 payment due September 15 is another $4,500. Send it. You're protected. It doesn't matter if you end up owing $30,000 in April 2027 because you had a breakout year. The safe harbor still holds, and the IRS cannot charge you an underpayment penalty. You'll owe the balance, but penalty-free. That distinction is worth real money at 8%. Here's where the rules get interesting, and where the high-income variation matters. If your 2025 AGI was, say, $200,000, that 110% rule kicks in. Same $18,000 prior year tax becomes a $19,800 safe harbor target. Divide by 4, that's $4,950 per quarter, not $4,500. Miss this adjustment and your safe harbor evaporates. The IRS will calculate the penalty quarter by quarter, not annually, which is the part that surprises people. Even if you catch up in Q4, the penalty for the underpaid earlier quarters still applies. Your filing status changes this too. Married filing jointly uses combined AGI against that $150,000 threshold, so a dual-earner household with two strong incomes hits the 110% rule fast. Run your own number. Don't assume. The current year method is the other option, and I want to be direct. I don't recommend it for most freelancers, but you need to know when it's the right call. The 90% of current year path makes sense in exactly one situation, when your income has dropped significantly from last year. If you made $150,000 in 2025, but a major client ended in January, and you're on track for $80,000 in 2026, paying 100% of last year's tax is overpaying by thousands. You're loaning the IRS money interest-free. In that case, project your 2026 income, calculate the tax, and pay 90% divided by 4. To do this, you'll need to estimate self-employment tax. That's 15.3% on the first $168,600 of net earnings in 2025, and the Social Security wage base rises to $176,100 for 2026, according to the Social Security Administration's October 2025 announcement. Then layer your federal income tax on top using the 2026 brackets, and don't forget the Section 199A Qualified Business Income Deduction, which can cut your taxable income by up to 20% of net business profit if you're under the phase-out thresholds. The math is more work. The protection is thinner. Use this path only when the savings are real. Let me walk one more example, because the current year method trips people up. Say you're a single freelancer projecting $100,000 in net self-employment income for 2026. Self-employment tax, 100,000 times 92.35% gives you 92,350 of SC taxable earnings. Multiply by 15.3%, that's 14,130 in SC tax. Half of that, 7,065, is deductible above the line. So your AGI starts around 92,935. Take the 2026 standard deduction for single filers, $15,000 per the IRS inflation adjustments released in October 2025, and you're at roughly 77,935 of taxable income before QBI. Apply a 20% QBI deduction on qualifying business income, and your taxable income drops further into the low 60,000s. Federal income tax on that, using 2026 brackets, lands around $8,000. Add back the 14,130 in SC tax. Total federal tax, roughly 22,130. 90% of that is 19,917. Divide by 4, your quarterly payment is about 4,979. By Q3, you should have paid roughly 3 of those, or around 14,940 cumulative. That's the current year safe harbor in practice. Compare it to your prior year number and pay whichever is lower. Now the piece almost nobody gets right. State estimated taxes are a completely separate calculation with completely different rules. California requires 30% in Q1, 40% in Q2, 0 in Q3, and 30% in Q4. And yes, that means a California freelancer owes nothing to the state on September 15. New York wants 4 equal installments. Pennsylvania has its own quirks. According to the Tax Foundation's 2025 state-by-state review, 41 states impose an income tax with their own estimated payment schedule, and the penalty rates vary widely. Do not assume your federal calculation tells you anything about your state obligation. Check your state's Revenue Department site directly. The September 15 federal deadline is firm, but your state deadline might be different, and the penalty math is independent. A few more traps I see constantly. First, don't subtract your Q1 and Q2 payments from your safe harbor target, and then divide by 2 for Q3 and Q4. That's not how it works. The safe harbor is calculated per quarter against a required cumulative amount, and the IRS Form 2210 worksheet treats each quarter as its own deadline. If you underpaid Q1, paying extra in Q3 doesn't fully fix it. Second, the EFTPS system, the IRS's electronic federal tax payment system, takes 1 business day to schedule and process. If you're paying on September 15, schedule it on September 14 at the latest. Third, if you're newly self-employed and 2025 was your first year, the prior year safe harbor still works as long as you filed a 2025 return covering 12 months and owed tax. If you owed 0 in 2025, you have no safe harbor floor. You must use the current year 90% method. Fourth, if you're a W-2 employee on the side, that withholding counts toward your safe harbor and is treated as paid evenly through the year, even if it was all front-loaded. That's a legal quirk worth exploiting. Bump your W-2 withholding in Q4 to cover an estimated tax shortfall, and the IRS treats it as on time for all 4 quarters. I've used this trick to clean up clients' underpayments in December. One more thing worth flagging, the annualized income installment method on Form 2210 Schedule AI. If your freelance income is wildly seasonal, say you earn 80% of your money in Q4 because you sell holiday products or run year-end consulting projects, the standard equal quarterly assumption punishes you. The annualized method lets you pay based on income actually earned in each quarter. It's more paperwork, but for genuinely seasonal earners, it can wipe out a penalty entirely. I work with 1099 earners on tax and retirement strategy, and this is the single most underused tool I see for creative freelancers, wedding photographers, and tax season bookkeepers. If your income arrives in clumps, learn this method. So here's my bottom line recommendation for Q3 2026. Pull your 2025 Form 1040 right now. Look at line 24. If your 2025 AGI was under 150,000, your safe harbor is 100% of that line divided by 4. If your AGI was over 150,000, multiply by 1.1 first, then divide by 4. Subtract what you've already paid in Q1 and Q2. Send the difference by September 15 through EFTPS or IRS Direct Pay. Document the confirmation number. That's the playbook. It takes 10 minutes. It legally protects you. Stop overthinking it. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this saved you a penalty, subscribe. I publish the tax and retirement playbook your employer would have given you, but for solo workers. And if there's a freelance tax question you want me to break down next, drop it in the comments and I'll work it into a future video. See you on the next one.